What's Making Headlines? Your weekly wrap-up of the biggest news stories in the Australian mortgage and finance broker market.
Hello and welcome back to What's Making Headlines. It's Annie, Ben and Will here giving you your weekly wrap-up of what's been happening in the news. It's been a busy week this week, I think, guys. How's your week been? Will, what have you been up to?
Yeah, it's been good. I guess more fallout from the RBA decision. Enough to be keeping busy, but not a manic week, I'd say, which has been nice.
Yeah, we'll be unpacking some of what the RBA have been talking about this week later on in this podcast, so stay tuned for that. Ben, how about you? You've had a bit of a busy-ish week, but not necessarily with news.
Yeah, it was a very strange week for me. I sort of had to get finger surgery on Tuesday. It didn't really come into the week expecting that was going to happen either, so that was a little bit weird, and had a few days off. So yeah, getting back to it today. I always get a bit anxious when I'm away from the emails for too long.
I did actually see you online a couple of times emailing. I was like, what are you doing? But speedy recovery for you, sporting injury, and hopefully be back to your sporting career fairly soon after this.
Yeah, I injured myself trying to catch a football. So that's pretty.
Sometimes
says everything.
It happens. Yeah. It happens. Yeah. I also have had a busy week. I went down to Melbourne this week for the MFAA National Conference and Excellence Awards, and that was really good, actually. Really great fun to talk to so many different people, see what the MFAA has been up to, talk to brokers and industry suppliers, and see also at the end, with the awards, who's been a national champion. We always are really, really interested to see how the associations kind of put on their events and which of their members are winning awards, because of course we also have our own awards across both MFAA and FBAA members taking place in August, the Australian Broking Awards. But at the MFAA National Conference, one of the big announcements that they announced was a new broker qualification, which I thought was so interesting. I had a great chat with Annie Kane, CEO of MFAA, about this. But long story short, if I can kind of abbreviate, I suppose, what the qualification is, it's looking at basically bringing in a university level qualification for experienced brokers. Now, I was talking to Anya in an interview for this story, being like, well, why do this? Because as we know, the MFAA already has a requirement that brokers, once they've done their Cert 4, have to then move to get a diploma as well. The FBAA doesn't have that requirement. And this is like a third element on top, where they're saying, well, actually, we really want to professionalize this industry. We really want to have brokers, as they already are, well used by borrowers, but really seen as professionals and seen as proper advisors. And as you know, here on The Advisor, we think brokers already are credit advisors, doing a lot of their mortgage and commercial finance strategies for people, not just broking. It's actually looking at strategy. And so Anya was saying, for the last 5 years or so, they've actually been working on trying to professionalise the industry through a new qualification. And they did this now in conjunction with the Royal Melbourne Institute of Technology Online, or RMIT Online, and putting together this package that really is kind of looking at what does it take to actually lead a business as a broker. So I guess your Cert 4 is kind of the fundamentals of, finance, and then the diploma builds on that. But this is more around actually leading a brokerage. So how do you become like a much sort of stronger leader? How do you take your business into the future? So I think it's around 40 hours of learning. It's done online. It's called, I don't even think I said what it's called yet. It's called the Mortgage Finance Professional Australia Designation, or the MFPA. And they're billing it as the first professional mortgage broker designation in the country. So, yeah, you've got 40 hours of study. You have different courses, and they kind of cover 5 areas. So ethics, education, experience, examination, and entity. That's sort of the main areas. And in order to qualify, brokers are having to apply for it. It's not something you can just do. So you have to go in, you have to be an MFAA member, you have to have done your diploma already. You need to have a minimum of 5 years experience as a practicing broker or show equivalent experience. You need to have settled a minimum of 250 loans. And you need 2 professional references from people, one from an aggregator talking about your tenure and your experience. So then you kind of go through an application, they review your application, and then you can potentially go through. So then you have to go through the different core modules, so leadership, customer engagement, business management, and an elective module, which is either SMSF lending or financial analysis for mortgage finance professionals. And then also, demonstrate things like professional standards and ethics and leadership. So I thought it was really interesting. And again, I was the question that I asked Anya was saying, well, if we're moving to kind of try and get more brokers to be professionals and have this designation on their, on their email signatures saying, hey, I'm a MFPA, akin to how accountants have CPAs. I was like, well, is the idea then that people have to start charging for a professional service? If you go to a financial planner, you pay a fee. If you go to an accountant, you pay a fee. You're expecting to pay a fee for a certain level of professionalism and a certain, I guess, end result. But if you're also then starting to move brokers into that cohort, is the next sort of argument saying, well, if you are professionals, then you should be paid for it. Now, Anya was saying that's not at all what we're saying. We don't think people should have to pay for a broker service. We think the commission structure works. We think the way the remuneration structure works is really good. But we do want people to be able to turn to a broker and be like, this is the next level of broker. So kind of really seeing who's out there, who's been the most experienced. I thought that was just really interesting. It kind of becomes more like a competition for brokers. It being like, hey, I've got an MFPA on my on my email signature. You can kind of brag about it.
Yeah, I think a lot of the brokers I've spoken to have been really keen to sort of explore professional development opportunities and that kind of thing. And they always talk about learning from peers and sort of sharing knowledge. So yeah, it's probably a good thing from that respect.
Yeah, I do think it makes sense as well in the way, some accountants almost collect these professional qualifications.
There's so many letters after their name. Yeah. Like CPA, blah, 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 doo-ba-doo, XYZ. Yeah. Their business cards just sort of running off with all the letters. But I think that is kind of the thing. And Anya Panik was saying, the MFAA CEO was saying, well, this is really also a form of self-regulation. If we can lift standards ourselves, we're actually just taking the whole industry forward and therefore kind of hopefully sort of self-regulating that way by just showing that we've got really experienced professionals here that are doing something awesome for their consumers. So I thought that was really interesting, and you can check out that whole story in the interview with Anya that we did. And we also talked to her a few months back when we were talking about education standards, and this has been something we've been talked about a lot on The Advisor through our podcast actually. And at the time I was speaking to Anya, and she was saying, we think qualifications do need to lift. We don't think they're high enough. And lots of brokers, I think, when they first start, tell us on the podcast, whether it's a new broker podcast or the elite broker podcast, they say just the barrier to entry is really low, which is great, but it should then kind of change. We think there should be higher standards, and lots of people questioning, once you kind of get started, you don't really feel prepared to run a business. So this is sort of, I guess, trying to mitigate that. The other sort of things that they were talking about at the summit were lots of chat about AI as well and how brokers are using that. And again, I think the clear sort of takeaway both from the sessions at the summit and in some of the follow-on speeches were kind of around AI is going to be super useful for doing lots of different things. But of course, the main thing will be the relationship between broker and their borrower. And Anya's also delivered a speech at the conference where she was talking about her future vision for the broker of 2030. She made it clear, actually, which I hadn't thought about yet, that we're actually now closer towards 2030 than we are to 2020. Which I
that was scary.
Yeah. We're now more than halfway through the decade. I was like, oh, don't know about that. So she was sort of saying, well, where do we see the broking industry in the next 5 to 10 years? And she was really like, yeah, of course, we want to professionalize. And part of the reason why we also need to do that is because we want people to use brokers as advisors and for advice. And they might, with the technology coming online very quickly and lots of transformation in technological space in mortgages as well. She's like, we really want to make sure that people are aware of what a broker does and that they're getting a really wonderful human and professional service when they do. So I think a lot of that is sort of, again, looking at saying, she was also saying, 80% should be achievable market share, but really we need to work on making sure it's a channel of choice. But yeah, lots of stuff going on there. And of course, then we had the awards in the evening, and it was so much fun being able to see all the winners. And the advisor was a sponsor of the awards this year. My colleague Meg Benson gave away the Lender BDM award. So that was quite fun for her to like see all the lenders that we talk to day in, day out and talk to some of the BDMs. And congratulations to Ruhi Kumar from St. George Bank, who took home that award, and to everyone who was a winner on the day as well. We'll take a quick break here. When we come back, we'll be talking about what else has been happening in the market, including what's been happening at the RBA, serviceability buffers, and some acquisitions in the aggregation space. And we'll get into that just after this. So this week, we also had the minutes coming out from the Reserve Bank of Australia's meeting earlier this month, talking about why they did what they did, which, as we've unpacked previously on this podcast, was the shock move of doing nothing. But yeah, Will, you were writing this up for us on The Advisor. What do the minutes tell us?
So essentially, a lot to unpack. There was quite a lot of repetition, but the big takeaways, I'd say, were essentially they kind of reaffirmed this cautious and gradual manner that they want to ease rates. And the big thing about that was to hit inflation and employment targets. I'd say that was kind of the main point that they wanted to really stress. They said that current setting of monetary policy was modestly restrictive, was the wording they used. They touched on tariffs, and they essentially said there was little discernible effect from tariff wars, and that the fallout of tariffs from the US hadn't been as bad as they first feared. The other thing which is new, which was really interesting, they specifically spoke about market expectations, and obviously there was I think it was like 97% were expecting a rate cut, and it was interesting to hear them actually speak about that specifically. And then Michelle Bullock, the RBA governor, gave a speech yesterday, and someone specifically asked her about the discussions around the market and what the market was expecting. And she basically said, we discussed it, but it didn't influence our decision in any way, and that although we spoke about it, that's not something we consider, which is interesting because they'd never previously explicitly said that. Yeah,
I guess because they would, it's funny, I think in the past they've sort of had to say, the decisions that they make at the Monetary Policy Board often have to take into consideration, huge amount of material. Yeah. I think they do, though, look at market expectations, but the issue they have is that their pricing, thinking about what the cash rate's doing, and they're kind of saying, well, this is what the market thinks, but the market's saying this is what we think the RBA's doing. Yeah. So they're kind of feeding both into each other's thought process. It doesn't really work. If they're kind of going, we think the market thinks this, but the market only thinks this because they think we think that. It's just so confusing.
Yeah. Well, whenever she gives a speech, when you look at the market tracker, it changes. So she influences that.
100%, yeah.
And then obviously if they're influenced by the market, it's such a weird self-fulfilling prophecy. Yeah.
Yeah, so I think in the minutes it says the market pricing implied that a further 2 reductions in the cash rate over the remainder of the year were expected. So this is them saying that's what the markets think. So we have to think about what the market's thinking about. It's just so just this sort of constant cycle of sort of self-reflection, which I think is really funny. But we also knew, because this was the first time we also saw the voting sway of the Monetary Policy Board, first time they actually voted on it, the first time they released the votes at least. And we've talked about that previously. And I think looking at why people have been voting the way they were, so I think looking at, the fact that some wanted to stay and some wanted to cut, but the majority wanted to stay where they were. I think, again, lots of that kind of chatter being around, well, we just want to wait for more information, including things like quarterly CPI, which comes out at the end of this month, looking at unemployment figures, seeing what's happening with all the other sort of economic conditions that we're tracking. So I think generally that's sort of something that they were looking at, and how kind of the actual economic indicators for headline trend mean inflation were going, and generally they sort of then were sort of split. But I'd be still so curious to see this in more detail. I want to see the actual minutes, not just a sort of summary. I want to see a transcript of what people said.
It would be really interesting to see how they vote. Well, I don't think they'll ever do, but that would be
who actually
exactly,
voted. Yeah. I think the other thing that we're sort of seeing across the board at the minute is looking at, well, what does that mean for the housing market? And you had some interesting stories published this week, Will, looking at, well, what do housing, what does happen in the housing market as a result of interest rate cuts, and what are we seeing at the moment? So what was the sort of takeaways for you on that?
Yeah, so loads of kind of new data that's come out, and a lot of it's kind of the fallout of rate cuts this year. So specifically house prices. So this is new data from the June quarter, and it's essentially shown that all capital cities in Australia, so territory and state, house prices have gone up, and that's the first time in 4 years. Yeah.
So basically, since we had the peak pandemic.
Yeah.
Mega buy-up of property.
Yeah, and then that's so record highs in Sydney, Brisbane, Adelaide, Perth, and then as a fallout from that, rising house prices are pushing more people towards units. Obviously, like they think
more affordable.
Yeah, more affordable, but also probably investors will think gains will be higher for units, which is interesting. And that's obviously house prices have been going up for ages, but the unit thing is interesting that's clearly accelerating. And then as another I guess like effect from that, I spoke to Two Red Shoes mortgage broker Brett Sutton, and he said he'd seen a big increase in demand for upsizing. He said that there's kind of a window of opportunity where you have more borrowing capacity, but that hasn't been fully reflected in house prices. And now's a good time if you wanted to upsize. He's seen loads of people do that. While there's a bit of a time lag before house prices increase more.
Yeah, so I think this is always kind of the way, isn't it, with the housing market, is that it just gets really kind of makes the wealthy wealthier, and it makes those who not yet in the market even harder for them to get into market. But yeah, dropping interest rates, you would have thought that the impact of dropping interest rates would be more people coming into market, which is kind of what we've been seeing. I think generally some of the preliminary data we've seen since the rates started dropping in February is that more people are looking to buy and trying to get in quickly. Some people were waiting for the new guarantee scheme to open, so I think July will be pretty busy. But actually, I did read a couple of stories recently, which I thought quite interesting, looking at a lot of people having not realised that they need their tax, the notice of assessments filed before they can actually qualify for a guarantee scheme loan. So if you haven't yet filed your tax, you might not qualify. I thought that was quite interesting. So most people, I think, at the moment probably wouldn't have done it. Just beginning of the financial year. Maybe some eager beavers have. But yeah, if you've kind of wanting to get a guarantee loan for your first home guarantee or regional home guarantee or the parental guarantee, then the family home guarantee, then I think, yeah, you've got to get your self-assessment done ASAP. But I think also looking at how the opportunities are there is really interesting, and it's great to see the broker commentary there talking about, while it might be harder for home buyers to get into market, there were all these solutions coming through, like the guarantee schemes. Yes, house prices are going up, which is the major concern. But of course, for people with existing mortgages or existing property, that's a good thing because they can then become, in a stronger equity position. The other thing we've been talking about a lot when it comes to affordability is what's happening with servicing. And we know that that's been improving as rates have been coming down. But we did hear from the prudential regulator this week again. They constantly are reviewing their macroprudential settings to see if they're appropriate. And this week, APRA had a look at theirs and released their results. What did they find, Ben?
Yeah, so basically the headline is APRA has announced it will leave the mortgage serviceability buffer unchanged for the moment at 3 percentage points after it's sort of reviewed domestic and international financial risks. The regulator pretty much said it weighed high household debt, strong credit growth, easing inflation, lower rates, and a still tight labour market. It believes lending standards still remain sound and non-performing loans are relatively low. So I think the regulator sort of sees that as no reason to tinker with the serviceability buffer as of yet.
Yeah, and I think, we were talking about this a lot last year when it was really hard to service a loan. Now that rates are coming down, easing up a little bit, But I think it is interesting that when it comes to the serviceability buffer, like every time we see them come out and confirm what they're doing with the settings or if they're going to be changing the settings, every single time people are like, drop the buffer, because they want to see more people in market. But we are already seeing that. We are seeing a lot of activity. You know, recent stats we've seen from the aggregators coming out is like record volumes being written, both for average dollar size, because of course house prices are going up, but also in terms of number of loans they're writing. So we do know there's a huge amount of activity in market. So I guess MAPRA, they're like, well, people are still getting into market, they're still buying houses, so there's no real problem here.
Yeah, I guess a prudential regulator is always going to err on the side of caution with something like this as well. But yeah, we've talked for ages about sort of, I think FBA sort of floated the idea of having a sort of not a static buffer, but a sort of
a dynamic buffer.
Yeah. And the MFAA sort of talked about a similar thing as well. So it's been a bit of a topic of interest. But yeah, I guess APRA is just saying at the moment there's still enough room for borrowers to get into the market, I suppose.
Yeah, and I think as you know rates come down, so I think the expectation from market at the moment is that we'll have at least another 2 rate cuts this easing cycle, and going into probably early next year. That's obviously depending on what on earth happens in the next 6 to 12 months. But I think generally the kind of market consensus for where we are now is that we'll have at least 2 more rate cuts. So I guess this will become less and less of a problem servicing, because the buffers will be going down. The interest rates will be going down, so the buffer will be easier to achieve. We'll take a quick break here, but when we come back, we'll be talking about some of the things we're seeing from the other regulators, from ASIC, and some new acquisitions coming through as well. We'll get into that just after this message. So we've been talking here about APRA, which is the prudential regulator. But the other regulator we heard from this week was ASIC, the Securities and Investments Commission, basically the financial services regulator. And they were talking about a new review they're doing into the debt management and credit repair sectors, which I thought was pretty interesting. Now, brokers will probably know a little bit about credit repair. They've been probably working with credit repair providers to look at if there are any sort of blips on people's credit scores, like how do they overcome those? And again, debt management, what does that look like? And basically, ASIC was saying there's been some naughty behaviour here, and we want to take a look at how the market across the sector is operating, because there's been some unlicensed activity and maybe some concerns that people have been operating unfairly or dishonestly, and potentially leaving particularly vulnerable customers worse off. So ASIC was saying we're going to have a look at how these companies are operating, particularly if they've failed consumers. And I think this is always a good thing to have ASIC looking at different areas of concern, and whenever they're being told of problems, that they're actually coming out and doing something. And we did know that this was going to be something they were looking at. They announced their core enforcement areas and priorities at the beginning of the year. So we did know this was coming up, but we hadn't really seen the details. It's the first time we're hearing about what it's actually going to be looking at. So about 100 credit licensees are currently operating in the debt management and credit repair sector. And what they're looking at is sort of saying, well, we had the licensing regime come in 2021. This will be the first time they're kind of reviewing it, similar how they did with the current data gathering exercise, the best interest duty in the broker space. They're like, 4 years on, how's it going? And how are we seeing that the laws are protecting consumers from predatory practices? So basically, they're going to be looking at the different styles of business models out there in operation, and they're going to look into instances where debt management firms may have failed consumers by not meeting their terms of their debt management agreement, either charging high fees for no benefit or no service, or maybe not communicating properly with clients. They did note a couple of times they've been flagged where people had been trying to contact the debt management or credit repair company and had just been left in the ether and never heard anything. And then eventually when they do hear, they basically, one person apparently got told, you have to declare bankruptcy. But they were like, well, we've been paying you for this service. Like, what are you doing to help me?
Yeah, one way to manage it.
That is one way of managing debt, become bankrupt. So obviously that is not a great experience for anyone all round. So Commissioner Alan Kirkland at ASIC was saying, we're just concerned that some of these licensees may be failing to engage in credit activities efficiently, honestly and fairly, and really, again, highlighting some of the examples of people having things repossessed or having to declare bankruptcy because of a failure of the debt management firm. So obviously not great, but good to see that things are being cracked down on when they need to. Actually had a great chat with Victoria Costa, who is from Credit Repair Specialist Credit Fix Solutions, about this, because I was like, well, what do you think? And she was like, it's still great because there are some bad actors out there and we want to make sure that they're stamped out, and we want to make sure that borrowers are using reputable companies, and that brokers also can trust the companies they're working with their consumers. You know, she's like, at the end of the day, we're helping their customers. We want to make sure that brokers themselves also know who is a kosher player and who isn't. So she was very, she wrote an opinion piece actually for us on the topic this week. So do have a look at that too. And the other big thing that had people clicking this week, one of our breaking news stories, was about AFG's third investment in a brokerage. Now, what caught my eye about this investment is that while they'd previously announced partial, like, minority stakeholdings in brokerages before, I think earlier this year they had taken minority stakes in 2 AFG brokerages. This is the first time they've taken a stake in a brokerage that wasn't an existing AFG member. So they've kind of branched out, they've diversified and taken a 28% stake, a non-controlling stake, obviously, in a Sydney-based brokerage, which is Loan Path Finance. I actually didn't know too much about Loan Path, had to look them up, but they were founded in 2019. They offer both resi and commercial lending with a specialised focus on high net worth individuals and self-employed clients. And it's headed up by Managing Director Mina Gergis. And they were basically saying, yeah, it's the first time we've bought a stakeholding in a company that wasn't aggregating through us, but because of the stake, this company is now moving across to AFG. So they were previously with Outsource Financial. So that's going to basically see it kind of look at growing its company. This is all part of AFG's broker investments platform program that they've been rolling out and trying to really empower the next generation of brokers and making kind of strategic choices by taking a stake in them and helping them grow. So kind of without, taking over any kind of brand identity, just saying we really want to help you scale. We want to help you succession plan. We want to help you either, transform your business as you want to. So if by taking a minority stakeholding and kind of giving quite a substantial capital injection, these brokerages can do what they want. And I'm just going to quote here from Gergis, who's the managing director of the brokerage. He said, "Our vision has always been to deliver tailored, high-impact lending solutions with a premium service. AFG's investment allows us to deepen that mission and scale with strength while maintaining the independence and culture that define us. The backing of an ASX-listed entity will assist to propel our business to the next level." So as we say, that's the third acquisition, not full acquisition, a minority stakeholding that AFG's taken in brokerages, the other 2 earlier this year being Empower Wealth Group and Lifespan Mortgage Services. What do you guys think about this? Do you think it's interesting to see aggregators take a stake in brokerages underneath them, or do you think that kind of is a logical step?
I think it's interesting, yeah. I think it'd be interesting to see, because they've kind of hinted that this is their strategy and there might be more. It'd be interesting to see.
Definitely be more, I think.
Yeah, interesting to see the kind of precedent it sets going forward, I would say. And obviously it's a minority stake, but if they want to do a majority in the future, it'd be interesting.
Yeah, and I think it's, again, really, I just want to see, I would love to see the contract. I want to know what exactly are you getting from it? Like, is it just cash? Are they kind of taking, any sort of profit margins? Like, what actually does that look like? I'm just curious to see what, I'll have to call up these brokers and be like, what's happening here? But I think it's interesting. I wonder if any other aggregators will start doing a similar thing.
Yeah, so the brokerages retain a degree of independence, or?
Yeah, so they're not, because AFG is a non-branded aggregator, they're not branded in any way. Yeah. It's just they have now 25% or more of their brokerages owned by an aggregator who basically can give them a little cash injection to help them do what they want to do.
Yeah, it's probably one of those things that doesn't fit every sort of brokerage, but for the ones it does, it's probably a great advantage, and particularly with the things like you mentioned, like succession planning and that kind of thing, having a partner like that can be a real asset. Yeah,
and I think this is something we're going to continue to see the next few years, because we've already started to see consolidation in the industry with a lot of the first generation of brokers retiring, but also just because of the cost and the headache of being a broker, it can be a lot easier to consolidate operations Or if you want to super scale, having the big players come together as well, to form super groups. Like we've seen that a lot. We've seen lots of, Flint is kind of one of the things I could think of where we've seen other brokers come together, join together to kind of do this almost sub-aggregation type sort of model. I did a podcast recently with Matt Pongras at Cert Finance, and he was mentioning he's about to merge his business with, actually acquired another business, and they're bringing their businesses together. So looking at seeing lots of this movement in the industry, lots of people consolidating and bringing together their operations to form much stronger groups and bigger groups. So I'll be really curious to see how this goes forward. I think, though, what does interest me specifically about this is that it's the aggregator doing it. It's not brokers coming together. It's actually an aggregation group taking in stakes in brokerages, which I think is pretty interesting. Anyway, we talked quite a bit there about what's been happening this week, and there has been lots, as always, on The Advisor that we've been writing about. We've got magazines, we've got all our podcasts. So if you missed anything, then it'll all be on the website, theadvisor.com.au. And of course, take a listen back to previous episodes of What's Making Headlines to catch up on what's been happening in the news. Otherwise, we'll catch you next time for Elite Broker or New Broker here on the Advisor Podcast Network.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.